Good morning and welcome to the market right here on ET Now. I'm Avanne Dubash, with me Nikunj, Dalmia as well as Anisha, Jain. And let's start off the show by putting context to how the markets have fared in yesterday's trading day. And by and large, it was a positive day of trade, 19,800 being held on to, but range bound at best, given the tight range that we were confined to. You did have the broader markets though, and that really seems to be the talking point, given the fact that the Nifty small cap index fell for the third straight session on the trot. So a little bit of profit booking being witnessed there. But nonetheless, for our frontline index, it was the highest close since the 20th of September. A little bit of selling being witnessed within the banks. And from the October lows, there has been a tremendous up move, in particular double-digit gains of nearly 11 and 13% for the mid and the small cap indices respectively. But Nikunj, that profit booking in the small cap index and the broader markets, no cause for concern, right?
So I was looking at the real punchline to describe the market, and the way I would describe the market is that the direction is up, momentum is missing.
Yeah.
Now, why the direction is up? Look at the Nifty, whether it's yesterday's intraday close or the fact that Nifty is closed at its highest level from September, end of September, that tells you where the direction is. But even though the direction is strong, the markets are not making rah-rah moves. It's like a market where you are taking one step forward and then you are pausing. Then you're taking one step forward and then you are pausing. So I think that is the construct of the market in which markets are moving. You know, Anisha and we were discussing yesterday, and you know, Avanne, soon you'll be discussing these stories with your daughter, the rabbit and the hare story, right? What is the rabbit and the tortoise story?
Tortoise, yeah.
The tortoise gradually moves, but it moves up. That is large cap for you.
Yeah.
The rabbit goes faster,
Breakneck speed.
but at breakneck speed, but eventually they will just hit a pause button or they become sleepy. That's small cap for you. Right now it is a tortoise versus a hare story. The small caps are the rabbit, the large caps are the tortoise, which means directionally you know that tortoise is moving higher, but it's taking time before it reaches a new high, and small cap, you know the speed at which they are growing. So I think the direction is strong, but the momentum is missing.
Time to write a children's book. There you go.
Children's book, and teaching them already about SIPs and the markets,
Yeah.
because you start early and you compound well.
You know, someone asked me actually, and we were discussing this a couple of days ago, and they asked me that, okay, you know, you've been a market commentator for 20 years, and what's one thing which you think you would like to change? And I was very open in admitting it, which is that, look, you know, I understood the power of compounding very early, that what it means, right? Whether it is market or whether it is habits. But unfortunately, by the time I started implementing it, I learnt about it in 20s, but I started implementing in my 30s. So my appeal to anybody who's watching the show is that, you know, I've lost 10 years of implementation of power of compounding.
Yeah.
Please don't do that.
Yeah.
Power of compounding is the most beautiful thing, whether it is money, whether it is habits, whether it is bad habits also, you should avoid power of compounding in the reverse, but yeah, that's the way it is. So remember, it's a rabbit, and it's a rabbit in a tortoise story. Large cap, tortoise, mid cap and small cap, rabbit.
Okay, so that's the best way to put it, and of course our appeal would be start early and make the most of that power of compounding as well. But what's happening across the globe is also important to put in context. Of course, today the US markets will be shut on account of Thanksgiving, but ahead of that they managed to end comfortably in the green. Actually, the US 10-year yields had actually dipped to almost a 2-month low, and on account of that we saw a bit of a risk on rally as far as the equity markets is concerned. Quite a bit of volatility when it comes to crude prices as well. Intraday we saw over a 4% dip in crude prices. It had gone below the level of $78 per barrel, and that happened because OPEC decided to delay their meeting. Earlier it was slated for November 26, and now it's towards the end of the month. So that put a bit of a spanner to works as far as crude prices is concerned. Having said that, this morning they've pretty much recovered. Crude prices are again close to that $80 per barrel mark. But Nikunj, you know, the global markets have been doing their own thing. Of course, S&P is sitting at, you know, multi-month high. Nasdaq is sitting at 22-month high level. What kind of correlation should we draw from India? Because even when the rest of the markets are falling very sharply, India wasn't falling that much.
Anisha, look, the construct of the market, at least in the month of October and November, I think is global in nature. I mean, has India done very well in isolation? The answer to that is actually no. You know, we may feel very happy and say, okay, the best game in the town for global investor, but we are not the best performing market of this year. Keep China aside and you compare India with, let's say, other markets, we are right in the center. Not the best, not the worst, we are right in the center. So the construct of the market, I guess, at least in last couple of weeks in my book, has been global. Post what happened on the geopolitical front, there was a bit of a stutter and there was a bit of a stumble in, let's say, October. Post that, I think global markets have made a comeback. Crude is down, dollar index is measurable, VIX is under control, silver is not shot up, gold is not shot up, I beg your pardon. So I think a large part of the market action is largely centered around global markets. And globally, as of now, I don't think markets are really worried about something, which is that, Fed, you've heard from Fed, you pretty much know which way the macro data is moving. Yes, there is a big move which currently is happening in the AI world, but that is something what everybody in a sense is not really worried about. So the way I look at things is that for a rally which, let's say, started in end of October or early November, is there a line of sight for a bigger gain or a last hurrah or extension of this rally till Christmas or till year end? The answer to that may well be yes. Why? Because you don't see too many pitfalls and you don't have too many calendar events, and typically the seasonality factor will always kick in. So I will not be surprised that the rally which started, let's say, in month of November may just have few legs. So depending on what you're asking, whether you choose a rabbit or a tortoise, I guess directionally both of them are going to go higher.
Okay, there you have it. That's the tale of the tortoise and the hare, and being explained in a market analogy standpoint. That's the Nifty implied open, by the way, on the gift Nifty at 19,895. But let's get a move on and also tell you about all the action within the primary markets, because that's hot this week for sure. Tata Technologies, Fed Bank Financial, IREDA and Flair Writing Industries. All four of them, all seeing their IPOs open, and of course the overall responses that we've witnessed on various days. And just looking at what we have seen for Fed Bank, till 5 p.m. on day one, it was subscribed about 38 times. For IREDA, about 4.5 times. Flair Writing, a total subscription of about 2.1 times. That's on day one. But of course, a big talking point and the cynosure of all eyes, Tata Technologies. And within minutes, you saw those, pretty strong numbers coming in. And total subscription at about 6.5 times on day one, Nikunj. No surprises there.
No, actually the numbers will be magnified by the time the issue opens. I mean, we will get some 30-40 times kind of a number, because please remember, first, the IPO cycle is no longer a 21-day cycle, it's a 3-day cycle. Before you realize the IPO is open, email hits a mail that, okay, this is a press release and that's when the listing is happening. It only takes 3 days. Beats a Tata group of company. We've discussed enough that, okay, why are they going public and what is the business. But I guess what is important here is that issues like Tata Tech or D-Mart, they go public. Some of these companies are built to last companies. And when they go public, you will not get them cheap. Because what we are saying, nothing new, market has discovered that already. So what is the best approach? Well, the best approach is that if you've not got them in the IPO market, and if you have a genuine 3 to 5 year time frame, and you said, look, I'm happy to digest a 15-20% volatility, maybe a year of no return, then even if Tata Tech IPO opens, let's say at a reasonable pop-up, which is 25 to 30%, 30 to 35%, it may make sense for you to buy it actually. Now, when it comes to ICRED, it's a completely different, kettle of fish. It's in a business which is going to be growing, but it's an issue which is not very cheap. But again, there is a credit cycle risk associated with it. So I'm not so sure whether you want to buy it after the IPO pop. But Tata Tech, I mean, the example I give is that look at, some of the fantastic IPOs like D-Mart. When they went public, even though they were expensive, they kept on creating wealth. And considering what the average P multiple of the Tata group of companies is, even if it aligns with the sector P in that space, I think it still has a long, long way to go.
Okay, that has a long, long way to go. In fact, this is one of the questions we posed to the management as well, as to what's the long-term outlook of the company. Listen into what the managements of Tata Tech and IREDA had to tell us.
We certainly think, as far as margins are concerned, that there is incremental improvement through operating levers. We are at the moment 50-50 in terms of onshore, offshore revenues. We are not an India out company. We are a very balanced onshore, offshore company. We represent a global proposition, and we think that there's the opportunity to grow our offshore contribution to the sort of 65-70%.
If you see last 3 years of CAGR of our loan book addition, it is more than 30%. And if you see the sanctions and disbursement, CAGR is 72 and 56%. So which means we have tremendous potential to lend, and we only need to augment the supply side, that is the borrowing side.
All right, let's get a move on then and focus levels. We've got Naresh Mirani as well as Kunal Bothra, our charters, joining in on the show. And Kunal, let's talk a little bit about the divergence that we're seeing within the frontliners, in particular for the Nifty bank, seeing selling pressure, and the fact that the frontline index is holding out and, as you've been saying for many days, positive direction but lacks momentum.
Well, yes, Avanne, good morning. This is the state of the market over the last 4-5 trading sessions. If you look at a 30-40 point band for the index, we call it as a range. But then, over the last many days, we've seen different sectors, different stocks trying to get into recovery, some of them getting to breakout. So that sector rotation is definitely at play. I think that's leading to some sort of positivity across market breadth, because even in the last 5-6 days of consolidation, we've not seen the market breadth collapsing as such, but we've seen the market breadth fairly positive net. So I think that's a sign of the markets being a bit more vibrant. What I like about the setup over the last couple of days, specifically yesterday, Nifty closing above the 90,800 mark. I think this was a bit of a hurdle for the index, both in terms of a psychological level as well as in the previous rallies. This 90,800 mark was acting as a support. So in this phase of the recovery, the 19,800 mark was acting as a resistance. Hopefully, if we manage to just surpass about those levels and even build minor gains above 19,800 mark, we could probably be getting into a zone of further momentum on the upside.
Okay, so that's the take coming in as far as the index is concerned. 19,800, an important psychological level being crossed for now. Naresh, what's your take regarding a couple of these big stocks that made quite a bit of move yesterday? Infosys saw a bit of a breakout. Reliance finally seems to be going towards that 2,400 rupee mark. Axis Bank held out. What does it tell you?
So the first signs came from Reliance Industries with a break of a 1 to 2 month high. And that is taking leadership that could go towards 2,500, 2,550. Same way, yesterday we saw Infosys make the first move, made a 4-day, 5-day high, and has been holding on well over the last few sessions. So if Infosys goes towards 1,600, Reliance goes towards 2,500, we get that tick towards 20,000, 20,200 on the Nifty. So overall, we are seeing one by one a little bit of an uptick in all the heavyweights. We are yet to see a similar uptick in the large cap banking names. At least we saw some bit of a recovery yesterday from the lows, but we are yet to see positive price action. So the bias is positive. The Nifty has been doing better than the bank Nifty. But once we start seeing some banks also do well, we could also be looking at a momentum shift happening on the upside for bank Nifty. So overall, the bias is positive, but it's a slow and steady move.
Let's get those top trading calls going then. And Kunal, looking at the charts, what are you picking out for the day?
So focusing on large cap names over here, Tata Steel is the first stock which I would recommend as a buy. Now, interestingly, over the last 5-7 days, we've seen at least a 7 to 8% recovery for Tata Steel. Relatively, it's stronger than most of the other metal peers so far in the last 7-8 days of recovery for the stock price. I think that could be a classic case of a possible breakout for the stock. So would suggest a buy with 134 as a target, stop plus 122. And Infosys over the last 1 week or so has given signs of a strong breakout. Yesterday, it completed a bullish flag pattern breakout on the intraday charts. So would expect another follow through up move, 1500 as a target, stop loss 1434.
Okay, so those are the top recommendations from Kunal. What about you, Naresh?
So first is a buy on Sun Pharma. The stock has hit a new 8-year high, crossing above the 2015 high. So clearly, that's a big breakout. It could be start of a slow and steady up move. In the short term, also, it gave a breakout above the 1160, 1170 mark and has followed up in the last few sessions. So expecting a short-term target price of 1300, stop loss at 1170. Second is a buy on Bharat Forge, which gave a swing high breakout yesterday, has consolidated in the short term for the last many sessions. Looks like a fresh trend towards new 52-week highs here. Stop loss at 1050, target price of 1200.
All right, there you have it. That's the view coming in from our chartists in terms of individual stocks that they're betting on. But lots of newsmakers as well that will be in the spotlight today. Let's discuss some of them then. And in particular, Mamaearth's parent, Honasa Consumer, came out with their quarterly numbers. A growth in margins, revenues as well have been pretty strong across the board. Volume growth has come in at about 27%. And in terms of their overall value market share, going by the individual categories as well, that has been fairly healthy, Nikunj.
Look, you look at their growth and then you say, okay, it's a very impressive growth at which they're growing their business. But bear in mind, it's a small base, and bear in mind some of the categories in which they are right now, they are trying to be a disruptor here. So you look at the growth because of the low base, because of the categories they represent, I think the growth is stellar. The call you got to take is that, is this a business where there is a very strong moat around their business? You know, for example, with Zomato and Swiggy, you know that there is a moat, only two-player market. But with Mamaearth, that may not be the real deal. The real deal is that the entire space or the entire cosmetic space, I think, is highly competitive. Local brands, foreign brands, you know, niche brands. Can Honasa really spin their magic, and can they really continue to innovate and grow the market share? That's a call. I think it's a very difficult call to take if you're a pure investor. Having said that, I think what they built an excellent franchise. It's a franchise which some would say, you know, let's say 5-7 years ago looked impossible that a new entrant will come back and they could really challenge some of the old guard in terms of some of the category domination. I always look at, and purely we're discussing purely market here, look at Nykaa when it went public. When Nykaa went public, it listed at a stellar premium. But the minute Anisha Avanne market realized that, look, there is competition coming from Reliance, there is competition coming from Tata's, the stock has done nothing. Whether it is online or offline model, whether it is Reliance or whether it is Arvind, whether it is Birla or Tata, Nykaa stock is languishing at a time when just about everything has made a comeback. So with Honasa, my whole point is that the options available by the existing players, where the growth will be lower, but the return ratios and profitability path, I think, is very well defined. So for me, I think if one is really taking a really long-term view, which is 3-5 years out, a bit of leap of faith, and then assumption that the management will be able to do something special, then this really fits the criteria. I'm not expecting anything magic to happen in the stock, looking at the positioning, at the valuation, and where they are right now in terms of a growth trajectory.
Okay, not a near-term play, but long-term is something that you can take a bet on if you are looking at those various parameters as we highlighted. Having said that, Jefferies has managed to upgrade their EBITDA and EPS estimates for FY24 to 26 by around 5 to 6%. The target price now stands at around 530 rupees. They say that the management is quite confident of 30% plus growth in terms of revenue. In the first half, they've clocked in around 35%, and the EBITDA margin also have levers for improvement on a year-on-year basis in the coming years, led by the operating leverage and the further optimization of ad spends, because at the time of IPO, those ad spends were one of the biggest questions that analysts and investors were asking the company as well. That was about Honasa. We'll watch out for it today. But the other one is the metal space. Has been seeing quite a few volatile moves, of course, on account of the dollar index. But structurally speaking, CLSA is talking about how the spreads have come in at a historical low. Now, the Chinese steel spread have corrected to almost $100 per ton, which is the lowest that we have seen in the past 15 years. Having said that, there is some improvement in terms of demand environment because the recent policy action taken by China is incrementally positive, not by a whole lot, but some amount of positivity there. And the Indian demand has managed to hold out quite well. So any improvement that we see in the global prices of steel will help maintain that Indian premium as well. And overall, if you look at their pecking order, they like Tata Steel in the ferrous sector, Hindalco in the metal space, and Vedanta is something for which they have the target price unchanged. Nikunj, how should one position themselves when it comes to the metal sector? Because as usual, there are just a lot of moving parts when it comes to metals.
See, I have a bit of a contra view here, which is that whatever could go wrong for metal has gone wrong. China was supposed to come back, it has not made a comeback. Coal prices have really gone through the roof. You've got really a very lackluster kind of a global demand environment. Is that something which I think markets are pricing in? The answer to that may well be yes, because you have to buy steel stocks and metal stocks and commodity stocks when the news is bad, when there is a chance of a cycle to turn. So is there a case for the cycle to turn or margins to expand? Now, can the cycle turn looking at what data we are getting from China in terms of how spreads are moving there, what is happening to domestic revival? The answer to that may well be yes, that 2024 for the for the steel sector and the metal sector could be much better given where the Chinese economy positioning is. B, I think somewhere if steel spreads are coming down, that means it is highly unlikely that the uptick in coal and other raw material will sustain. So either steel spreads have to go higher or coal and other raw material has to sustain. So even if demand uptick does not go up and if raw material prices come down, can the spreads improve? Can the spreads really improve? So my sense is that if you're buying steel, especially ferrous right now, where I have a slightly better understanding, I don't track non-ferrous that closely, is that you're actually buying it at the peak of bad news. You're buying it at a time when just about everybody is convinced that the cycle is not going to start, because the cycle was supposed to be strong 2 years ago and then it got hit because of what happened on the geopolitical front, and given that the Chinese economy has not really fired full cylinders. So it may not hurt to be a contra buyer here, because if China kicks in, markets will be surprised. And if spreads are contracting, that means coal prices and other raw material prices have to come down. Otherwise, spreads will not sustain.
Right, okay, so like you said it, whatever could have gone wrong perhaps already has when it comes to the metal space. Tell you what, we'll slip into a short break, be right back as our fundamental guests and chartists share with us their top market views.
Welcome back. Well, the big laggard for the market has been the banking index, and yesterday as well we saw a sharp slide in the banking names on an intraday basis after RBI governor talked about how the asset quality needs to be monitored, the interdependence between NBFCs and the banking space has to come down, and this is something a lot of brokerages too have picked up. We'll put all of that for you in perspective, but first up, listen into what the bankers have to say on the recent commentary coming in from the RBI.
The impact is more on certain NBFCs because they have a higher threshold of capital adequacy. So maybe they might look at whether they have to raise. On the banks, I don't think immediate capital raise is required by any bank. There's no question of winding it down. So we are on record having said that our portfolio is largely to salaried people. And as long as they continue to demand, and salaried also, these are largely public sector, government, police, army. So such entities, and as long as there is a demand from them, we will continue to fulfill the demand.
As far as RBL is concerned, we have made a complete assessment of it, and we also shared with our board. We had a discussion with it. The net impact on CET1 will be around 60 bips at the end of the year. If you look at September, my impact is only 60 bips. That is going to be the impact, and we will not be impacted beyond. And this 60 bips is not going to impact our plan for growth.
Slightly higher risk weight and therefore higher capital is not a big concern from our perspective just now. No, we are not planning to go much lower. I think we are making the right choice. See, each bank has its own profile of their unsecured lending. As of now, we are comfortable with our.
Okay, so that's the latest coming in from the, the banking arena as to what the bankers have to say on the RBI decision. For now, they're not expecting big capital raises to happen, though the loan growth might temper down. At least that's the verdict coming in from Macquarie as well. They're expecting a couple of 100 basis point reduction in the loan growth rate that we have seen. But the other stock which is going to be in focus today is TCS. And the reason is that the record date for the buyback is 25th November. And if you go by the T+1, today is the last day that you will be eligible to be eligible for buyback if you buy the share today. Now remember, the buyback price was set at around 4,150, which is almost 18% premium to yesterday's closing market price. The buyback size was around 17,000 odd crores. And we have done some analysis in terms of what the acceptance ratio can be and what would it mean in terms of the retail shareholders who participate, what kind of upside it is for them. Now, if you expect, if you go by the history, of course, earlier we had seen that the retail acceptance ratio was quite high at around 100% in 2017, 2018 and 2020. But last year in 2022, the acceptance ratio was quite low at around 24% because a lot more people people participated, because remember at that time we had seen a sharp slip as far as earnings are concerned of some of these companies as well. Now, if you go by the current trend, if the retail participation remains high, then acceptance ratio can be lower. If you assume that the acceptance ratio is around 25%, then gains would be capped only to 4.4%. So there's not big money to be made as far as this buyback is concerned. So overall, lower acceptance ratio will mean bigger gains, higher acceptance ratio will mean a bit of lower gain. And for now, of course, while a few brokerages have recommended that one should tender in the buyback, you need to be watchful that there's not big money on the table, and perhaps the recovery is on the anvil, because we have seen the worst play out. Q3 for TCS will be hit on account of that 125 million provisioning, but maybe they are talking about recovery from the next half of the year in terms of Q3 and Q4. So we'll watch out for that. But Mr. Bhasin also joins us to talk to us about all of these stocks. Mr. Bhasin, let's start with IT itself. I know Persistent has been one of your favorite. Tech Mahindra had really played out very well when you had recommended it. Which are the other stocks from the tech from the IT sector that you're picking out right now?
Yeah, good morning. Anisha, HCL Tech has also been one of my outperformers. I continue to think that is an outperformer. And you can add an LTTS. I've been saying that for the last 2 days. The specific space in defense which they have, that is doing extremely well. And the order book and the execution will take maybe another 4 quarters. But they have a very constant flow, and that is going to be very positive. So HCL Tech and LTTS is something where you can even now put your money on.
Curious to get in your take on Honasa Consumer, or Mama Earth, if you will, Sanjeev, in terms of just understanding the kind of market that it's operating in. Do you think that the same treatment down the line could be meted out to Honasa that was to Nykaa after that stellar listing?
Yeah, good morning, Avanne. I think you'll have to get one of the ladies to tell you more about that. I don't track Nykaa that much, and I think it's a wonderful company, but the valuations have never been to my liking. Same is the case with Honasa. We will wait for more color on the numbers. Don't take this one quarter, let it more play out. But we know this is a very, very growing field, and the acceptance is much higher for the new millennials. However, the competition in this industry is going to make it difficult to make money. So I would rather go with Paytm, Zomato, and PV Fintech, which have been 3 of my top picks. And I continue to stay focused on those 3 stocks. These are 2 stocks which we will have to wait for more deliverance on numbers.
But Mr. Bhasin, what about the banking names? And I'm talking about large cap banks. If you have, let's say, like of ICICI Bank, Axis Bank, or HDFC Bank in your portfolio, what should one do? Should you get out of that and probably buy mid caps because there's a bigger, alpha there, or just stay put? Their time will come too.
Well, if I see the present last 2-3 days, it's actually, more of the large caps which are showing you strength. And if the index has to go higher, it will have to be large cap banks. And I think this undue concern raised by the RBI is a good cause of concern, meaning, he's voicing. But it has hardly anything on the ground effect. We all know that, this personal loan and all had reached a climax, and most banks are well capitalized, particularly the large cap ones. And if you are seeing the type of activity in defense, power, railways, they are all conduit to PS, banks being the lending institution. So I continue to think overweight on these banks. Axis as being my top pick. You can add some of the mid cap banks, which I think again are giving you an opportunity. But this fall in the bank nifty is more to do with sentiment. Actually, I think banks will come out with very stellar numbers. And like the State Bank chairman pointed out, a little bit of maybe 2 or 3 basis point on the NIM could be the marginal effect, if at all it is. And yes, the lending from NBFCs and all, that is a good point of concern. But I think there is enough buffer on the other side, and most banks are very well capitalized. I still think HDFC, ICICI, and Axis should be in all portfolios, and maybe they've underperformed for the last few months, but I think now they can start to be in line with market performance.
This group which has given stellar returns, and you got to hold your breath. No pranayams, but just hold your breath here. Hold your breath, because the kind of return what you've seen in, let's say, a tube investment, a Coromandel International, even for that matter, Carborundum Universal, this year, well, they may look okay. But the minute you compare them from COVID lows, let's say 2020, it's just been absolutely amazing. From COVID low, Carborundum Universal, which is by the way a cyclical stock, is up 2x to 2.5x. Look at Tube Investments, 3x. Chola, some of these stocks have seen absolutely stellar returns. Sanjeev, you know, we spend a lot of time discussing Reliance, HDFC Bank. We spend a lot of time discussing a lot of other names like Zomato and Paytm. But the stealth move has actually happened in some of these South companies. We don't talk about it. But when I started my television career, they were the sultans of South. And they are still the sultans of South. It's just that we don't pay too much of time in discussing them and look at the wealth they've created.
Correct, Nikunj, I would back you 100%. And you know, these are very, very strongly entrenched brands and they have been outperformers. You can add a Chola Mandalam and an Ashok Leland. Ashok Leland also from those lows of 30 rupees is back to 180. That is one stock and Chola which are in our portfolio. But you rightly said, you know, people are missing the woods for the trees. The bigger picture is playing out superbly. But Nikunj, remember that some of these market caps and the floating stocks are not as much as entry and exit is easier. Reliance, ICICI are large caps which are most preferred by institutional investors because entry and exit also is an opportunity. So if you take the implied cost, sometimes these stocks will become long-term gains, but in the short term, they may turn to be a sideways. But like you said, no running away from the point that the South stocks, you can add a TVS Motor also, which has been the darling of the auto stocks which are hitting all-time highs. So I am fully with you. The broader market is still giving you a lot of strength. That is why if you do your homework correctly, and mutual funds have actually missed the boat because a large part of them did not delve into PSUs, which have been the biggest wealth creators in the last 3 years. Whether it is defense, whether it is railways, or whether it is power, and those are continuing to make new highs.
What have you sold in your portfolio? You know, we always say ye liya, wo liya. क्या बेचा? कुछ तो बेचा होगा ना?
हाँ, थोड़ा बहुत हमने रीवैल्यू किया अपने पोर्टफोलियो को. Some of the large cap consumer names we've actually sold out. I have sold out on Chola and Mahindra as a disclosure, and we've added, like we told you, we are very bullish on Idea. From that 11 and a half, we've added that. Now I know these are slightly high risk, high reward, but so was Suzlon at 8, 10, 12 rupees, and it's 50. So I am not making the case, but there is a fundamental change. You know, even today, people are wondering what BHEL is doing. If the stock from 25 has gone to 150 and still is a loss-making stock. So don't compare the future with what the markets are discounting. Markets are discounting that the order book for the next 3 years on power transformers is the best ever in the last 5 years. And so is the case with maybe a Vodafone, which we are extremely bullish. We think the transition now has been superb. And if you see we as an entity, they are just on that anvil of raising capital, which will again reinforce the back machinery. So you have to be in slightly names which have had a murky past, but the future looks very, very bright.
REC, PFC, what a year it's been. Kunal, when will these stocks go from safe zone to overbought zone, or are they already in overbought zone?
So they are already in overbought zone.
Can they remain in overbought zone? No, We've seen that in bull market that stocks can remain in overbought zone for a long period of time. You should not sell because they are overbought.
Yeah, so that depends on the time frame you're looking out for. So if it's a daily overbought, then we expect a 10-15% correction for stocks.
10-15% correction.
10 to 15% correction. So, if you remember, there was a point for many of the PSU banking names, like the likes of, I think, Central Bank, UCO Bank, etc. We were discussing this point that many of these banking stocks have gone into an overbought territory. And from there on, there was not just a time-wise pause, but even a price-wise correction for these stocks. But for REC PFC, the good part about the chart so far is that the overbought territories occur only on the daily time frame. They've not been occurring on the weekly or the monthly time frame, and that's why even though these stocks get into those odd phase of corrections, it's just on an average, say a 10% odd correction for these stocks before they resume the uptrend. So even in a very similar kind of a stance, I think 2 days back, the charts for REC, PFC, they've come back into a overbought territory on the daily chart. So what we may broadly expect is another round of a 10% correction before they start resuming an uptrend.
Naresh, how would you approach PFC and REC now?
So it's a tough trade because actually the trade is to go short, but given that the overall trend is very strong, you don't want to be shorting and getting stopped out before it starts correcting. So it's overbought on various time frames. It's a stock which has done much more than it should in a single month or a single week going forward. So going forward, I would expect a 10-15% correction, but it would be a tough trade to take on the short side. Actually, time to take some profits off of these two names.
What is the turn? What do you mind, Sanjeev, is driving the entire power space? Is it just pure sectoral re-rating? Because power is one of the sector where you know that outside gains are going to be impossible considering that it is regulated.
Correct. But Nikunj, what we have to realize is that there was a history where NTPC and the likes traded at, there was a 10-11% dividend yield on those stocks. And they were just considered widow stocks. But, suddenly the deliverance of power, the acceptance and the distribution of power has been huge. REC, PFC, I stay in Gurgaon, by the way, DHBB and Dakshin Haryana Bijli Vidyut Nigam, after 35 years has first time declared a dividend, which means that the loss of transmission is now over. There is an FIR against non-payment of dues and regulation is very strong, which means recoveries are the fastest. And as we know, there is a sovereign holding behind REC, PFC, which are safer than Reserve Bank of India. So along with the dividend yield also came the lowest cost of money, and the distribution and recovery became very fast. And I think that is what has driven power stocks. You can say that they have reached a peak, but problem is they are still under owned, and PSUs, which were always hated, have still a valuation comfort even after running up so much. So thirdly, Nikunj, also take into account that if there is India inclusion in the bond index overseas, then sovereign bonds, NTPC, REC, PFC are sovereign rated bonds. They will have the first buying interest, and their yields can fall sharply, which will increase their net interest income and margin over a period of time. So we are not making the case to buy them immediately, but I think these are superlatives because of under ownership and very underpriced multiples for years, which have now come to realize.
All right, let's get a move on then, and lots of other stocks in news. Sanjeev, good to have you on board. Cipla in the spotlight, and it's a setback as the pharma major has received a warning letter from the FDA. Concerns have emerged regarding the operations for the Indore plant. Let's get in Srishti, who joins in with the details. Srishti?
Well, yes, days after the warning letter was issued to Cipla's crucial Pithampur plant by US FDA, we have the details out wherein they really don't look good because US FDA has highlighted data integrity issues for Cipla's Pithampur facility. This one is really crucial because Pithampur plant on an overall basis contributes around 30% in the top line, and one of the key products from this particular facility is the albuterol sulfate, wherein US FDA has said that they have flagged off the product complaints related to this particular product as well as microbial contamination, and investigations into the quality deficit complaints of albuterol sulfate inhalation aerosol were inadequate. There were more than 3,000 complaints, and the kind of a reply that Cipla has given US FDA is not satisfied for that, and US FDA observed that the company failed to extend the investigations to other potentially affected batches. US FDA seems unsatisfied of the practices as well as the CAPA. Other than that, they have asked the company to take a third-party consultant. They have also asked some data going back to the few years, and investigators observed a truckload of the bag of the scraps from the unit as well as bag of the scrap from their central scrapyard intended for shredding, though company has gone ahead and said that they have implemented new procedures for the document disposable. However, US FDA is not satisfied with the reply. Along with that, the warning letter also talks about the repeat observations at the Goa facility. So these were the points highlighted by US FDA, really not looking good for Cipla as of now. But going ahead, if there is an import alert for a particular drug, that could be a big concern for Cipla.
Thanks so much for putting that into perspective, Shrishti. But let's welcome on board Param Desai from Prabhudas Leeladhar as well to talk to us about Cipla and the rest of the sector as well. Param, let's begin by this with Cipla itself. This albuterol, how much of a hit could be, and given the data integrity issues, how long do you expect this mess to continue as far as the Pithampur plant is concerned?
Yeah. Good morning. So if you see warning letter means that your new approvals or new launches gets impacted. Your existing business is not impacted. And albuterol is an existing product. So as of now, the sales from albuterol will continue from this facility. Historically, if you see, Cipla's compliance has been pretty strong. They have always, in the past also, whenever they have got an observation, they have come out and it has not been escalated. Having said that, if this escalates to import alert, then yes, then definitely this will be a negative. But we do believe that the company had got an OAI, this facility was inspected in February, post that they got an OAI in August, and post that this has now escalated to warning letter. So it's almost now 7-8 months with the event has happened. So we do believe that unlikely that this will get escalate further to the import alert, though this may take some time to resolve. It may take beyond 12 months also. But company is also in the process to site transfer some of its key product to the other facility that will de-risk them. So in our assessment, yes, some of the observations are too serious, but we do believe that unlikely that this will get escalated to import alert.
Okay, so net Param, you're saying that everything seems to be factored in the price and you're not expecting a knee-jerk reaction or a sharp correction. And if it is there, you're saying that one should use that opportunity to buy.
Yes, we do believe that the warning letter is been factoring the price. Yes, the only risk is if this escalates to import alert, that is not factored in the price. So that we do believe that the probability of that is less.
And just within pharma itself, Param, because the sector seems to be coming back in flavor, talk to us about which are your top picks or top recommendations right now.
Yeah, so in the large caps, top picks are Sun Pharma and Cipla. Clearly, if you see the two key markets, US and India. So in US generic, we are seeing the price erosions be getting stabilized. There has been drug shortages. Some of the facilities or some of the US centric companies are facing compliance issues, which are getting benefited to the India centric companies. So largely, if you see, the US business has more or less been stabilizing in the last 2-3 quarters, and the price erosion has also been stable. So most of the companies are been reporting a reasonably steady base business. Along with that, most of the companies have a strong compliance record. So they have been getting a new approvals at regular intervals. Products like Revlimid, Spiriva are been aiding the US sales for most of the Indian centric companies. So net both US as well as India, the visibility looks very healthy. Also, if you see the raw material prices have been softening in the last 6 months, API prices. So that is also be getting benefited in terms of the gross margins, and that trend will continue at least in the near term. So in terms of our top pick, from a large cap perspective, Sun Pharma and Cipla are our top picks in the large caps.
And within mid caps then?
Yeah, in the mid cap, we do like a Torrent Pharma and JB Chemical.
Okay, point taken. So JB Chemical, Torrent Pharma, Sun, these are your top recommendations coming in. Thanks so much, Param, for making time and speaking with us. So that's the latest. Not expecting a big reaction on Cipla, and overall the sector seems to be poised for a decent growth. But let's welcome on board Hemang Jani as well. And let's begin with the pharma sector itself, Hemang. What's your view? Are you looking at, let's say, the hospitals more positively? What's the sense on the diagnostic space? Or is it the CDMO and pure play exporters which seem to be more better placed?
Good morning. Yes, I think pharma and healthcare as a space, is doing well. If you look at the recent quarterly numbers, I think with very few exceptions like Landmark, most of the companies delivered in terms of the revenue and more importantly, there was a margin expansion seen across Aurobindo Pharma, Sun Pharma, Dr. Reddy, Lupin. So I think, for companies, both in terms of the generics and the domestic market, things are looking better. So definitely one should really go for maybe large cap names like Sun Pharma, Dr. Reddy, Cipla. Incidentally, Cipla, I heard about the discussion. The fact is that the stock was up yesterday 1.5%. And this OAI was known very much earlier. Now there's a warning letter, but there's no impact as the critical products have already been shifted to alternate site. So, people would focus more upon the corporate action rather than this warning letter per se. So, and in terms of diagnostic, I think Dr. Lal Pathlab in particular, the numbers in the management commentary on next year, the pricing pressure getting eased out is surely good. So I think some exposure is surely, warranted in the diagnostic space, particularly Dr. Lal Pathlab.
Interesting. And yes, that corporate action in Cipla has been much talked about. Let's see as and when that does take place. But I know, Hemang, the last time you were having a conversation, you had a bit of a cautious view on the Tata Tech IPO. Now, on day one itself, it's been subscribed 7 times. Is there anything that has changed your view, given the kind of interview and the commentaries that we have been hearing from the management?
Yeah, so see, my view is that Tatas have very complex structure. The same kind of work is being done by multiple companies. In case of Tata Technologies, only large client appears to be Tata Motor, right? And the valuations, yes, the mid cap IT companies are commanding valuation which is at a premium to the large cap companies. But I do not find any great justification in valuing the company just for the sake of OFS. So, because of the fact that it's a Tata's, name and the technology company, you will find investor interest. I don't, deny that. Question is there a great justification in paying this kind of a valuation to a company which is just one big client and which is giving you, share at a 35, 40 times P multiple?
Sure, but in all honesty, the share or the revenue contribution from Tata Motors and JLR has been coming down from that 60-70%. It's now down to 33% thereabouts. But I take your point on board as well. But the other one, Kunal, I want to discuss with you is CG Power. Yesterday, of course, that stock was locked in upper circuit 20% higher. And then there's an IFL Securities note as well, which is saying that they're enthused by the OSAT foray. Yes, it is capital intensive, but the government subsidies make it very attractive and they're expecting returns in terms of 20 to 30%. And in fact, with the target price, they see a potential addition of 65 to 70 rupees. And that means that the implied target price on this one could be 600 bucks. But on the charts, CG Power and even other Murugappa companies, as we were discussing, Tube, Carborundum.
So, specifically for CG Power, the interesting bit of price chart is that the stock, corrected from, I think, 460 levels to 380 in the last 2 months. So, from the September highs, that was around 460 mark, towards the very recent low the stock had made was around 380 odd levels or slightly below this. So, it was almost a 20% correction, a drag for the stock, no sign of accumulation in terms of volumes, and all of a sudden you see the stock coming back towards 460 and breaking past that above those levels on a single day, which means that all those traders or investors who were probably selling the stock or trying to pair off the gains into the stock price, I think they would be forced to buy back again. That could lead to the second round of upside for CG Power specifically, and after such a kind of a strong price action move on a single day, you're bound to see some bit of follow through up move, if not today, but over the next couple of days. So would be bullish on the stock. Difficult to give a target because it depends on whether the stock opens with a circuit yet again or not. If not, then at least a 10%, 15% upside from yesterday's closing level is what we would expect. For Carborundum also, I think yesterday's sign of a breakout was also quite strong. It managed to break past again above the 50-day moving average, even though the stock is relatively lower than the previous highs in the month of September by a margin of 10-12%. But given yesterday's breakout, we would expect more traction into the stock as well.
Hemang, everybody is excited about suddenly owning real estate stocks. How much of the action in real estate stock is justified with what is happening on ground? Because this is one sector where you can look at on ground and then assess.
Nikunj, Mumbai, we are all here and we all can see the kind of activity which is going on and kind of digging and the pollution that construction activity has created. So both in terms of the activity, in terms of the sales, the fresh sales. In fact, pan India, when you look at the data point, Mumbai would be the highest selling market when it comes to the fresh sales for real estate. So, there is absolutely no denial that the activity across has been good. The only point here is that how much of that is already in the price, and is there any justification to, buy at current valuations? And are these numbers sustainable, right? So my take is that, at least in the near term, I think maybe 6 to 12 months, given the kind of buoyancy that we are seeing, there is going to be some interest. I would prefer to buy if there is a small correction, let's say about 5%, 10%. These are all high beta stocks. Interest rates haven't really gone down, and I'm really surprised that even at higher interest rates, these kind of numbers are being delivered. So I want to have some exposure, but purely from a momentum perspective, core holding I would prefer only if there is a meaningful correction.
Okay. Uh, Let's look at consumer staples actually, and consumer staples have also done rather well for themselves. Tata Consumer has hit a fresh high. Colgate is just marching from strength to strength. ITC is looking at some kind of hibernation. One was getting to some kind of an end, but this year I guess hands down it belongs to ITC. The real laggard has become the darling. Tata Consumer expensive but has had a good year, so to speak, because of its lineage. And then you've had a good comeback, so to speak, even in Colgate. Kunal, any trade in any of the FMCG names?
So yeah, Colgate is the best price performer, at least I think on a YTD basis, it's some 40-41% up, if I'm not wrong, compared to ITC, which is I think, of course, for the second consecutive year, but then this year also the stock has been up some 20-24%. Nestle is also another name which was also looking quite attractive on the charts. That's a stock which has been consistently doing pretty well. And if we do a relative price comparison for many of the the consumption names, the likes of HUL, for example, Marico, I think Britannia, all three of these stocks are trading at 10 to 15% lower than the previous swing highs, and I'm talking of the last 6 odd months of highs for many of these names. So there are two divergent trends within the consumption pocket. One is of course the likes of HUL, etc., which are trading at a 10-15% discount or lower range from the previous highs, whereas on the other hand you have likes of Colgate, you have the likes of Nestle, etc., which are actually doing pretty well and trading at their life highs, as well as maybe some of them are closer to the life high levels. So I think that's a clear sign of a trend emerging into very specific divergent pockets within the consumptions.
Sure, point taken. Actually, Naresh, I wanted your sense on a couple of these chart checks as well. NMDC, wherein Citi has actually opened a 90-day positive catalyst. They are saying that prices have headroom to rise, and there are reports suggesting that the company has undertaken a price hike very recently. Stock trades at 3.5 times FY25 EV EBITDA versus the global peers, which is 4.5 to 6x. So that's a view coming in from Citi on NMDC. And the other one I want to talk about is IEX. Bernstein has written a note recently and they have an underperformed rating. Now they say that they can't deny both the merits and demerits of the market coupling, but they are saying there's something has to give in because they can't believe that there could be a natural monopoly that will continue, and that too at a higher transaction charge. So they are expecting some sort of move to happen, whether it's broken by coupling or by reduction in transaction charge. Something will give away and the monopoly that IEX has will get challenged. But on the charts, IEX and NMDC?
So starting off with NMDC first, the trend has been strong ever since it broke out of 115.20 mark. It's been a classical higher top and higher bottom formation and has not been correcting much with the markets whenever the markets have corrected. So clearly a lot of relative strength in the stock with the index as well as with the whole sector. Now, if you look at the recent correction also, it's just been 3-5% from the top. Consolidating around the 170 mark, I would expect another fresh breakout, take it towards 190 to 200. So it's a buy at current levels and still a momentum buy even at current levels. So looks promising. Trading stop loss would now be at 165. So NMDC looks promising. On the other hand, if you look at IEX, that's a stock which corrected all the way from 300 down to 120. So it went from 60, 70 rupees to almost 300, and now has corrected and spent almost 1 year around this area of 120 to 150. And finally, in the last 3, 4 sessions, it's made a 6-month high. So technically, if you look at it, it's been multiple bottoms around the 120, 125 mark, and now starting up a trend. Out here, given that the stock has been very volatile in the last 1 year, there have been multiple gap downs with announcement. One has to be careful in terms of position sizing, but a stop loss below 136 and a buy at current levels technically.
Okay, thanks for those chart checks. But moving on then, and looks like people aren't really chomping as much on the likes of Domino's and McDonald's because the QSR space has already given up a lot of the gains that it made in the month of September. Even the festive season didn't bring much cheer, very limited growth for a lot of these listed companies. What really has led to this slowdown? We've got Vinny here with the details. Vinny?
Absolutely. Seems like, no one was munching on those burgers and pizzas this time. And especially since September, that fall has come in most of the stock prices as well. Now, what led to this sluggishness when you look at it in terms of the Q2 numbers? First, let's highlight in that also. The commentary and what we've seen coming in is that the same-store sales growth for most of the QSRs have seen a decline when you compare it quarter-on-quarter basis, year-on-year basis as well. Same-store sales growth had seen a decline coming in, indicating that obviously that weak demand is something that is persistent. Now, obviously, pizza demand, even in the last couple of quarters, we had seen pizza was not doing that well versus the burger company. So whether Jubilant Foodwork, Devyani International's Pizza Hut business, or even Sapphire Foods Pizza Hut business, that had not been doing well. But now what we're seeing that other cuisines in the QSR space, that is also not doing quite well, and that is also seeing a bit of a pressure and witnessing some weakness in terms of demand trends as well. Specifically, obviously, festive season, that didn't bring any cheer as well. Channel checks were suggesting that festive season was quite dull as well. Navratri didn't do anything in terms of a cheer. Pre-Diwali sales also saw a bit of an uptick, but nothing great in terms of the versus the last festive season as well. So yes, Westlife Development still less impacted compared to other peers. When you look at it in terms of the SSSG growth as well for Restaurant Brand Asia or Westlife, in Q2 was on the positive side. But whether you look at Sapphire Food, Pizza Hut business, Jubilant Foods, pizza business, as well as Devyani International's pizza business, that had seen a decline in the SSSG growth. World Cup also was something that didn't support in terms of the demand trend as well. And that is what that we're seeing, that there's a weakness overall coming in terms of demand trends. There's not much trend in terms of consumers actually going and eating much in terms of the QSR items. That is what is causing a bit of a pressure here as well.
Okay. Hemang, there's a sale on Jubilant Foodworks today. It's CLS is calling it expensive, and the data now seems to be saying that this entire binge or so-called QSR spend now seems to be stagnating.
Yeah. So Nikunj, we do see a certain period where you will see certain sector rotation and the numbers not being so great. But what we must understand that as a theme in a country like India, QSR will remain a big theme in terms of growth, in terms of penetration, and you will see a little bit of volatility, but one will have to have some allocation towards that. And when you look at the numbers, I agree they have not been great, but if you look at Devyani and restaurant brands, numbers were relatively better. Even Westlife. So I think, sector rotation is what I would call it. Theme, I think, is going to remain very strong from a 1 or 2 year perspective. Just to give you a case in point, can you imagine the kind of market cap that the Burger King enjoys being a global franchise? And it would not be even 3% of that in India with such a big market. So I think the potential is huge. You will have to really take a 2 year kind of.
All right, fair enough. That's the view coming in on QSR space. Need to take a longer time horizon to really assess the trends there. But let's take a look as to what the pre-open rates are indicating, and holding out at around the 17,785 mark, and for the Sensex up about 40 plus points. Let's find out what Kunal and Naresh are picking out as their mid-cap strategies. Kunal?
So I'll go with a mid-cap name, RHI Magnesita. That's a stock which yesterday gave a double pattern breakout confirmation. One on the daily charts where the stock bounced back from its 200 moving average. And the second is a formation of a double bottom pattern and the stock breaking past about this pattern with a breakout point of 730. So that's one of the major reasons why would suggest a buy with a target of 775, stop loss at 700.
What about you, Naresh? What are the stock recommendations?
In HPC, the stock tested the recent 52-week highs, pulled back a bit yesterday. The trend is still positive and the whole sector is buzzing. So out here, expecting a move towards 65, stop loss at 52.
Okay, point taken. Since we have taken the picks from our technical experts, let me ask Hemang as well for his top bet right now. Hemang, anything that stands out where you've done the work and you think it's a high conviction buy?
I think sugar as a space is coming back in action. Globally, sugar prices are forming up, and core story of ethanol and the entire balance sheet strength that started maybe 2 years back is very much continuing. So I think Balrampur is something that I would surely go with. The other name would be Titan. I think you guys must have seen that the US, outlet that they opened up, there were long queues, and I think at an aggregate level, the global markets like US and other markets would constitute almost about 4 to 5% of the sales, which I do not think analysts have factored in. So I think Titan and Balrampur are the two ideas that I would like to go with.
All right. Thanks, Hemang, for taking time out and joining in. Let's move right on, and here are some of the other top stories that we're tracking. An Israel-Hamas truce deal has been delayed at the last minute. The release of the hostages under a temporary truce will not happen before Friday. Now, earlier, the agreement was expected to come into effect yesterday. At least 50 hostages held by Hamas would have been released in the exchange for 150 Palestinians that have been jailed in Israel. And it's day 12 of the Uttar Kashi tunnel rescue operation. The mission to save the 41 trapped workers inside the tunnel seems to be on the verge of completion. Ambulances are on standby at the site, even as the officials remain in touch with the stranded workers. And the Met Department has issued an orange alert in Kerala and Tamil Nadu after heavy rains lashed the two states. They also anticipate heavy rainfall in Andhra Pradesh, and the forecast predicts heavy to very heavy rainfall across these states for the next 3 days.
Okay, so while there are rains in southern part of the country, it continues to be toxic air in the northern part. In fact, the fight against toxic air continues in Delhi as the AQI deteriorated in the national capital region. The overall AQI in Delhi NCR remains in the very poor category for the past 4 to 5 days, and no respite seems to be in sight for at least a couple more days. Stubble burning, meanwhile, continues in the neighbouring state, and that too has added to the pollution in NCR. But in the world of sports, days after India and Australia faced off in the ICC World Cup final, the arch rivals will clash again today, but this time the format is going to be different. It's the first T20 match between the two countries, which will be played in Visakhapatnam with Suryakumar Yadav, which will be leading the Indian side versus the Aussies, and hopefully here we'll have a better outcome than what we saw in the ICC World Cup final.